So hello everyone and welcome along to this live webinar. If you watch this webinar on YouTube, please feel free to subscribe to our channel to get more relevant content. And today we have a special guest and we are going to discuss about property sourcing and deal analysis. So Ahmed Khan is joining me. Ahmed, hello. Please say hello and feel free to introduce yourself to the people that might don't know you yet.
Hi. Well, firstly, thank you for having me. My name is Ahmed, and some of you might have seen me before on YouTube and other social medias. Yeah, just to have a quick introduction. So I finished university around 6 years ago, well, almost 7 years ago now. And I finished and went straight into property investing. Started by doing rent to serviced accommodation, which is essentially renting properties and then putting them onto Airbnb, Booking.com, some other platforms like Silverdoor and those sort of things. Did that for a good few years, and then I started moving into developments, but I started with very, very small developments. So for example, I started buying 1-bedroom flats in zone 1 in London, and I would then turn them into 2-bedroom flats and refinance. So essentially the BRR strategy, which we can go more into later on, which is essentially just buying, adding value, and then refinancing a lot of your funds back out. Did that 5 times, and then I wanted to move into something slightly bigger. So I started buying properties which I could convert into flats. So I bought a 3-bedroom house in Stevenage, which we turned into 2 flats. And then after that, we bought a mixed-use commercial. So it was commercial downstairs, residential upstairs, converted that into 4 flats. And so the projects I'm looking at currently are essentially anything which I can turn into multiple flats. So yeah, it's been a bit of rent-to-rent service accommodation, some small developments, get into some slightly bigger developments, but that's been the journey so far.
Amazing. Thanks, Ahmed. Now I will just present the agenda for today. So we start, introduction we just did. Then Ahmed, I think that if you can share some of your tips on how to source properties in an efficient way and basically perhaps some of your special secrets. And then we'll discuss, some tips about deal analysis. But I think that the best thing is just to go and jump into a live analysis. So Ahmed, you basically chose one property that we can analyze together using the Lendlord platform, using our deal analyzer. And we will actually we'll use the same property to analyze it as a flip and then to analyze it as a rental project. Basically some kind of like the BRR strategy if we will combine both analysis. And then we will have a session for questions and answers. So if you have answers, please feel free to put them on the chat or in the session of questions and answers. You can just raise your hand and actually you can ask the question or I will ask it for you. If we see that there is a question that is relevant to the topic that we discussed, we might stop and answer. I will put some links on the chat as well to subscribe to our YouTube channel and set up your free Lendlord account. And also if you want to schedule a demo or to apply for finance. And Ahmed, feel free now in the end of the webinar to put links if people want to get in touch with you. Okay, so let's start. So I think the first topic is mainly to hear from you how you look at property sourcing, how you do it, what is your best tips for people that look now to invest more in property or even just to get started?
Yeah, sure. I think property sourcing is probably the biggest thing that people struggle with, to be honest, because people find it very hard to get a good deal. My tips really are just every time someone says they struggle to find a good deal, I always just ask them the question, what is a good deal, right? Because only until, if you can't define what a good deal is, and that might be a 10% return on investment, that might be a £50,000 profit. It doesn't really matter what that is, but like, I would say 95% of the people haven't defined what a good deal is. So therefore, when you go into Rightmove, maybe a lot of those properties do work and maybe they are good deals, but if you don't define what that is, then you're going to struggle. So that's point one. The second point is But when I say, what is a good deal, one is from a metric point of view in terms of how much money you want to make. The second thing is from the point of view that what exactly are you trying to find, right? So what that means is when I was doing my 1-bedroom properties into 2-bedroom property conversions, when I was going into Rightmove, I had a very clear criteria in mind, which was I wanted 1-bedroom flats, which had a separate kitchen. The kitchen had to have a window. The kitchen had to be 8 square meters. The living room had to be 15 square meters. So I almost had a checklist in terms of what I am looking for from a property, right? So if you have a criteria in terms of, okay, I want to make a 15% return, and you have a criteria in terms of this is exactly what I'm looking for, you'll find it easily. Whereas if you don't have one of those two things, then the problem is every time you go into Rightmove, because you're unsure in terms of what a good deal is and how to find that deal, that is generally where people struggle. It's not because Rightmove doesn't have deals. Right, I bought all of my properties from Rightmove. It's just you have to be very specific in terms of what you're looking for. So that would be like my biggest tip by far. I think you're on mute.
Okay, yeah, thanks. Yeah, I think definitely, I think setting up a criteria and understanding basically also your limits and basically what exactly you are looking for. It's one of the main thing you need to be prepared before you get started.
For sure.
And one question before we start the analysis, Ahmed, when you, what are the steps you would do before you make a decision, if like to invest or not invest? And basically, I think it's related to the analysis of the deal, basically.
Yeah, of course. The reason I wanted to actually, like you mentioned earlier, I wanted to use the same property to analyze for a flip and as a rental was because one of my main points of analysis is that I don't generally tend to flip, but even if I was flipping and that was option A, so let's just say exit A, then I would also want to make sure that it still works as a rental, because let's just say for whatever reason you can't sell at the end, maybe the market's changed, maybe there's not as many buyers, you still want to make sure that you have a backup plan, a plan B or an exit B, which is potentially a rental. So I think when we go through the deal analysis using the Lendlord platform, and we analyze a deal as a rental and as a flip, if it ticks both of those boxes, I would then say for me that's a good deal, because sometimes a flip deal can make a lot of money, but then at the same time you have to realize you might not have a plan B, and if for whatever reason economy changes, there's a recession, something happens, and if you don't have a plan B, then especially if you're on short-term financing, then you're kind of stuck. Whereas if it ticks both of those boxes, for me, it's a safe investment. It might not be the most profitable investment in the world because I'm being a bit more picky with the ones I'm investing in, but I know there's no chance I can get burnt in any sort of way. So for me personally, those two analyzers, they both have to pass in order for me to sort of verify that it's a good deal.
Gotcha, great. So basically have a backup plan, and it can be basically the rental, or it can be even if there is a problem to get a tenant or to get a mortgage, for instance, then perhaps the flip can be.
Yeah, exactly. Exactly. So yeah, exactly. Has to in an ideal world work for both. If I had to pick one or the other, it has to work definitely at least for rental, because rental is generally easier than flipping.
Yep. Okay, sounds good. By the way, flip, I don't know if everyone knows, it means buy to sell. So basically you buy the property, usually you will improve it a bit, do some kind of refurbishment, renovation, and then sell it for a profit. And when we speak, the alternative is rental. And when you do a rental deal, it means that you purchase the property and then get a tenant, or improve the property to increase the value, then get a mortgage and a tenant and mortgage. A BRR is a strategy that we will not analyze a BRR deal, but we'll do like the same property with flip and rental. But BRR means that you buy the property, make a refurbishment, increase the value of the property, and then remortgage, get a long-term mortgage, get a tenant inside, and basically by that you actually in BRI the refinance can basically cover almost the entire purchase costs of the property if you do it right. So let's start with analyzing the deal. I will share the screen, Ahmed, and you will let me just tell me the address. But before we analyze the deals, we spoke about sourcing. So just for people to know that on your Lendlord account, on the invest part, if you can see the section property sourcing. So this is something new. It's now available on the QA environment, but it will be on production hopefully next week. And this is properties that are up for sale from agents. So basically you can find them on Lendlord. And basically it was a feature that now we basically just renew it. Then you have the auctions tab, and in the auctions page you can find properties from online auction houses all around the UK. You can review the property lot, and then you can see also the initial analysis for each deal. You can see the finance that is available for this deal, and you can click on place bid to go to the auction house page. Property lists, it's also something that we've added, and here basically you can select specific list, and then just put the, I will not do it now, like put the postcode, click search, and you will get also properties for sale. And the good thing is that it's integrated to the deal analyzer and also integrated to the finance app, so you can see also what finance options you have in order to finance the deal. And then in the invest part, you have the deal analyzer, and here you have the rental deal analyzer, and you have the flip analyzer. And we will start with the flip analysis. So, so let's start. So the first thing you need to do is typing the address. So Ahmed, which address we will use for this?
Yeah, so do you want the postcode first?
No, you can start with the number, and then I think
it's number 11.
Yes.
Hillside, HILLSIDE, Stevenage.
W.
No, SIDE.
Yeah.
Yeah, there's no road or anything. Stevenage.
Steve.
There we go. First one. Yeah, first one.
All right. Okay. So you can see like immediately we will receive the property information in terms of the property type.
Oh, by the way, you might have to change the change it from dollars to pounds.
This is a good idea. 1 second. I'm on the QA environment. Sorry, guys. 1 second.
Oh, here we go. It's done. It's done now.
Yeah. I just showed the sourcing page on the QA. All right. So
11 Hillside.
All right.
Correct.
Okay. So after you enter the address, you will see the property information, the property type, EPC level is important, of course, the internal area, and then some information about the postcode. So the average yield of this postcode in the last 5 years, and the 5-year capital growth, the average in this postcode. So I think it's useful information before you start the analysis. Okay, so the first section is the purchase details. So here basically you need to put the purchase price.
That's 350. 350.
This is the amount?
Yeah, that's right. And we are doing this as a flip one first, right? Yeah, flip one first. So, with something like this, just to give some context, so this is currently a 4-bedroom house. I would be looking to extend the side and convert it into 4 apartments. So the refurb cost is going to be, quite a bit. So for the refurb cost, I would probably estimate around the 150 mark.
150.
Mm-hmm.
Okay. By the way, Ahmed, we have the works plan generator, and this is a great way to just, make it more specific. So you can kitchen to description, notes, what will be the cost of this? Let's say, I don't know.
இல்ல எல்லாம் நங்கே ஆக்கிட்ட நீ என்ன தின்னுவ?
One
நீ என்ன தின்னுவ நங்கே எல்லாம் இல்ல ஆக்கிட்டேன்.
And then you can put the start date of the specific item in the works plan, the schedule of works, and then the end date. And then you can continue and add costs. So basically you can create schedule of works, and it's very useful if you want to share it with you know, with your project manager, with a broker, lender that might require this. And so this is, I think, very useful feature. It's part of our premium plan, by the way, which is £99 per year or £12 per month. And then, of course, you can export it to a PDF or download it to an Excel spreadsheet. And you have the entire cost of this project and the start date of the project and the end date of the project. So I will just add the other as a refurbishment, and you said that you want 150, so I will add the 138,000 as a generic item in this plan. Okay. Okay. So I will close this window. Okay, so we have 150K in refurb costs. The stamp duty, by the way, is calculated automatically. And the closing costs, you need to take into account legal fees, inspection costs, and other closing costs, and you can add other costs that you want. What would you put in legal fees here?
In terms of buying or in terms of selling?
Buying. The selling.
Yeah, but yeah, 1,500 is probably reasonable.
Inspection might be a bit higher because of the size.
Okay, like a valuation. Yeah, 600 or maybe slightly higher depending on the bridging finance. Maybe less, like 1,000 there. Yeah, 750.
Let's put 750. And other, basically, just if you want to put some buffers, you know, just to be on the safe side. And if you have any other closing costs, you can add them. Click save. Then you have it added. So basically, the entire investment in terms of this project is 518K. Okay. Now let's start discussing the cash investment versus the loan. What would you do, or what did you do in this case? You would take bridging finance, or
normally I would get bridging finance. I would try to get 75% gross loan to value.
Okay, so gross here, basically so like in the analyzer, we capitalize the interest. Is also I think the way that most of the lenders do. So let's put, I don't know, 68 or 67% net. Rates went a bit higher recently. And okay, and then, so basically it means that you need to put down for 54% of the entire costs.
Sure.
And this would be 283K. Yeah.
Yeah, I mean, you know, or you could try to get a refurb facility, I guess. What's that?
Sorry, yes. Basically, you can take just the loan on the 350.
Correct.
Take a second advance development or
for the facility on top. Yeah.
All right. Okay, then we have the monthly holding costs. So landlord insurance.
Yeah, 15 probably reasonable. Utilities, maybe a couple £100. Maintenance, there probably wouldn't really be much. I mean, if you're just flipping, you might have some council tax and stuff in there. Maybe just chucking another couple hundred. Yeah, 100. That's fine. Either one's okay.
All right. Okay, and then the sale details. So first, I think the most important thing, the length of the project. So how much time you think?
I'd allow 12 months, you know, just to be on the safe side.
And this should be the time to your exit strategy. So either if you're going to sell or refinance.
Correct.
Then you need 12 months. So you need to take into account that you need to complete the renovation.
Get it on the market and yeah, everything else which comes with it.
All right. And what is the sell value after you do the refurbishment?
Yeah. Each flat should be worth about 190. So 190 times 4, which takes you to 760.
Okay. The agent commission, 1% more, 2%.
I think 1% is reasonable.
Okay. And let's put some buffer on, I don't know, other sell costs just in case. All right. So now let's see the metrics. So the basically the profit is almost 200K, which means 70% return on investment.
Which you probably, I mean, you can probably increase that by getting a refurb facility and reducing some of your own, cash output.
Yes, absolutely. Yeah. Let me try something. I think it might work.
I mean, we can just artificially change that, right? So we can just add in a further 150,000 pounds, which is a further almost 50%. Yeah, but let's just put in 100%, I guess.
Yeah, you can actually even go higher, depends on the GDV. Usually what we do, by the way, in second advance, we will send like a second inspection to the property, second valuation, called GDV valuation. And then, based on the GDV, we can lend more. So based on the, the
Makes sense.
expected value post refurbishment. So let's say if you take it to 100%, but this will not be day one loan, this will be either in tranches or like second advance, then you reduce the cash amount that you need to put down. It means that your ROI will be increased to 107.
Yep, that makes sense. Happy with that.
Okay, I want to try something. If you shorten it in 1 month, yeah, then you can see that.
Yeah, a couple of percentages.
Yeah, because of the debt. So basically you have a loan that is expensive loan bridging, and basically every month will decrease your profit.
Yeah, no, exactly.
I mean, another thing I would do at this stage is to go to the postcode information page and analyze the postcode, just the area before I purchase the property. So I can see the 5-year capital growth in the last 5 years. I can see the property demand in this area. So how many properties now for sale, the average sales per month. And the bottom line, if it's a seller market or buyer market, seller market means I would say it's good for a flip strategy.
Mm-hmm.
Some statistics about crime in this postcode, price per square foot, and some data about demographics. So it can be the politics distribution, commute method, the age distribution, and some data about schools and other key stats that are relevant, council tax, flood risk, etc. Do you have something to say about the postcode? What is your view on?
Yeah, I mean, with the postcode, because it is a common question, right? Like, what do you look for in an area? I don't personally look at a lot of data purely because, like, for example, Stevenage, I've lived here for 20 years, and when I invested in London, it's like when you're in zone 1, a lot of sometimes those things don't really matter as much because you're going to be close to anything anyway. If I was, for example, looking to invest in an area which I'd never heard of before, I think for me the top left graph would be very important, which is the capital growth in that particular area, right, over time. Purely because if I'm looking to buy and hold, then I would want to be in an area where there is some sort of capital growth, because with buy and hold, fine, you do make some monthly cash flow, but the big thing that you're relying on is the capital appreciation to a large degree as well. So for me, it would be finding an area which has a lot of growth. But yeah, purely because I've always stayed in areas which I've known for years and years, I know where the good roads are, where the bad roads are, where the expensive properties are, where the cheap properties are, or, what the schools are like. So I've never really had to look at data for that because I've been here for 20 years, kind of thing. But no, capital growth would be the main thing, and also from a rental, I would want to make sure that the stress test calculation works quite comfortably. Now, in most areas, that should be fine. I can't see that being too much of an issue. In London, it's going to be slightly hard. In places with private property, but yeah, as long as my cash flow box is ticked and this capital appreciation box is ticked, that is generally what I would look for.
Yeah, sounds good. And another thing that you can do is to go to the prospect report and then get all the data about this deal is summarized. And of course, you can export to PDF, you can share it with others, or export the numbers to Excel. And then you can also look at the Google map and basically take a view on it on Google Maps. So this is the street, by the way.
I think you gone on the road which is next to that road.
Yeah, let me try again.
I think you might have zoom in slightly. It's actually a road which goes off that road. Yeah, you might have to zoom in quite a bit. Yeah, I think you put it on the main road as opposed to that inside road. Yeah, there you go.
All right, so let's go to inside.
Yeah, there we go. It's if you spin around, it's the one in the corner.
This one?
No, keep going. Keep spinning around. It's on the other side of the road. Yeah, it's the corner one. There we go.
All right.
It's end of terrace with a good size of a good amount of space on the side.
All right. Would you do that? Like you would go to Google Maps to see the street, if although you said that you usually the area.
I mean, if I didn't know the road, I would go on Street View. I think a lot of the times people view properties a bit too early in the process. I think you can do Google Street View and look at floor plans and look at data and look at so many things. And if you think about it from a deal analysis point of view, if I was, for example, investing in London and I live in Stevenage, if I have to go view a property in London, that's half my day gone, right? By the time I get there, view, come back. Whereas I can eliminate 99.99% of deals just through Google Maps and floor plans and the deal analyzer and everything else. So I only really view if it sort of like ticks every single box there is, because the amount of time it takes to view is probably the longest thing in the process. Even if you live, let's say, 10 minutes from the property, you still have to book a viewing in, arrange a time, go there or speak to the agent for a bit. You're still a couple of hours in. Everything else, I mean, we've analyzed this relatively quickly. I mean, in 10 minutes, you can analyze it. So I try to do everything online and only view if I have to.
Yeah, today it's actually, more possible. You have so many, technologies out there to help, property investors to streamline their,
of course,
and get the data that they need. All right, so now let's go to the rental analysis. So we ended up with a nice profit. So Ahmed, I think that for the rental, should we use the ARV? So let's do it like a BRR. So basically, you completed the refurbishment. The value of the property now is 760. Then I want now to get a tenant and a mortgage, a buy-to-let mortgage, and start generating monthly income. So here I would go to invest, deal analyzer, and click rental. So again, I will just put the address. Okay, so the first section is the purchase details, very similar to the flip analyzer. So here, I would put in the purchase price, I want to put, it's interesting because we can either put the actual purchase price that was 350 You know what? I will put it with together with the refurbishment and even together with the purchase cost. So this will take into
Okay,
account
so yeah, that makes sense.
the current value is 760. So basically it will
Sure.
take into account, so you will see the profit in the first year. The first year.
Yeah, that makes sense.
So, and by the way, you can get online estimation using this pop-up. Basically, in order to get it, you just need to put the details. Was it like it's a detached house or semi-detached?
Well, it'll be, I guess, oh, when you buy it, end of terrace.
When you buy it, okay. Number of bedrooms
4.
or bathrooms, 2.
But yeah, should be 2, yeah.
Was outdoor space, balcony, garden.
Garden. I'd say garden large, yeah. It has it because it has a wraparound garden on the side as well.
And off-street parking spaces.
No, it doesn't have any parking.
All right. So this can give you just like, you know, like indication. Doesn't mean that, so it's very close to the 350. Okay, yeah. That basically the purchase price.
Yeah, I think it is reduced. It did come on slightly higher, so it's sort of like reduced down to, you know, the 420. Well, 350, sorry.
All right. Okay, then let's go to the rent. So what would be the rental income for this property?
So yeah, each flat would be 900. So 900 times 4, that's 3,600.
Again, sorry, Ahmed.
3,600.
All right, which will give you almost 8% yield. This is a good indication. Gross yield. Then stamp duty has been calculated. The refurb cost. So I'm not going to put now refurb cost because we basically
factored it in, yeah.
Factored it in. So because we started with the flip and then we went to the rental. Closing costs, I believe you would need to pay some more legal fees perhaps in the refinance.
Yeah, probably another 1,500 probably. Yeah.
750. All right. So the entire purchase costs are 550. Then here basically we'll need a mortgage. So
I'll normally get a 75% loan to value.
Definitely. So 75. So here what the deal analyzer what basically does, it takes the lower between the purchase price and the property value. So you get 75%, but you could think that you can get a higher amount if you take 75% from the 760, yes?
Correct,
So,
yeah.
Okay, so for that basically I need to increase it to, so can you calculate quickly 760, 75%?
Yeah. So 760 times 0.7. So 570. And so therefore, if you want that as a, okay, fine. Yeah.
Okay, so yeah. I don't think that the platform actually, it's a good use case to support though. Because basically what we do is we take the lower between the purchase price and the property value.
Sure. Yeah, that makes sense.
I think that we can add definitely a feature that will allow you to change it and take the value.
Yeah. I think maybe, you know, because we're evaluating this just as a pure buy-to-let, if you scroll up, maybe, because no, the purchase price, I guess, is fair because it's 350 plus a refurb, so 512. Yeah, okay, that makes sense.
All right.
Yeah, that's all good.
In terms of the mortgages, you can click on explore your mortgage options and then click search. The platform will take the data from this specific deal. So Lendlord is integrated into a sourcing platform. So what you see here is live products from buy-to-let lenders based on your profile. So we know the criteria of each lender, And so if in the manage section you manage your portfolio, the platform will stress test the portfolio, will check the overall loan to value, all the things that the lender will check. And then you will see which products are available for you. And of course, you can also apply to get a mortgage. It's a digital process, but we have a team that can be in touch with you. You can review mortgage illustration online and also track your application online. I think one important thing here is to see the difference between the rate and the fees. So in this use case, it's a 2 years fixed. So you can see
Right.
low rate, but the fees a bit, I think, quite high. And you can see in this product, for instance, the rate is a bit higher, but the fees are lower. So I would also order by total costs for the entire period. So you can see that perhaps it's better to take this product.
Yeah. I was gonna say sometimes, like in order to, depending on where you are and depending on what the project is, and especially where the rates are right now, sometimes in order to make the stress test calculation pass, you have to go with the lowest rate. And if that means more fees, then you don't really have much of an alternative, because you might be able to get something with low fees and a higher rate, but if that high rate doesn't pass the stress test, then it's not really going to matter as much. Plus, the fees, it's not like you pay the fees up front anyway, they just get added to the loan. So if you have a 5-year fix, it's not like you're paying someone £12,000 out of your pocket. It just inflates the loan. So, over a long enough period, it doesn't really matter as much, I guess. But yeah, I mean, of course, I would want the lower fees, but if I can't make the stress testing pass, based on the higher fees, then I have no choice.
Yeah, I think it's a great point, the stress test, because basically it means the affordability. It means that how much you can borrow. Yeah, so it can impact the amount, if I'm not mistaken. Yes. All right. So this is the 5 years. Would you take 5 years or 2 years? Ahmed, can you hear me?
Sorry, could you say again? Got cut off my end.
I asked, like, if would you
Can
usually
say again?
I don't know if it's my signal is broken now, but can you hear me now? Ahmed, no?
I can hear you now. I can hear you now. Did you say, do I take 5-year fix?
Yeah, if like what would you prefer, like 2 years or 5 years? Do you have any thoughts on that,
Yeah, I normally go with a 5-year fix purely because when I was doing the stuff, in zone 1, the way the stress testing works on a 5-year fix is that it gets tested on the interest rate itself. So for example, you see a mortgage here at 4.6%, the stress test is at 4.6%. If you get a 2-year fix, then the stress test is at 5.5%. And if it's on variable, then it's on the mortgage rate plus a couple more percentages. So to cut a long story short, if you're struggling to make your stress test calculation work, sometimes it's easier to do it in a 5-year fix purely because the stress testing has the most leniency. So that's why historically I went with 5-year fixes. Now in today's market, if I had the choice, I'd probably go with a 2, not a 5, because my prediction is that interest rates will come down in the next year, 2.5 years. So I wouldn't really want to be in a 5-year fix, for the time being, because I do think they will come down.
Yeah, good point. Good point. All right, so let's select the rate. Just for this use case, I would select this rate. I can add the fees to the loan here with checking the tick this checkbox. Then let's speak about the monthly operating expenses. So here, basically, you need a letting agent or managing agent, or you can self-manage the property. But
yeah, let's just put in 5%. So somewhere in the middle, that maybe you do some work and they do some work, and yeah, has like a middle mark. Service charge, in this case, there wouldn't be a service charge because you're on the freehold.
Okay.
You wouldn't have utilities. You wouldn't really have ground rent either. You'd have insurance. Maintenance, I normally account for like 10% of rent. So that would be 360. Yeah, 360. So those would be the costs there.
All right. And then we have the last section is the long-term assumptions. So when you look at the rental deal, would you look at 10 years or more, 20 years? You know, it's a long-term investment.
Yeah, I mean, I have no intention of selling. So 10 years, 20 years, like my plan is to hold on for a very long time. In terms of appreciation and rental appreciation, I normally just look at Savills data and just, go on that sort of basis. I think the Savills rental prediction for the next 5 years compounded is around 18%. So if you look at it, that's about 3.5% per year is what the rent appreciation is. Annual property appreciation, I think for the Southeast, it was something like 12% over the next 5 years. Let's just say 2%.
So what I want to do, Ahmed, is to show like the what if scenarios. So basically, default, we can use, so what we do in the default, we take the 5-year growth in this postcode. So it's like, this is the default value. And then we can create the best case scenario, worst case scenario. But would you take on the default, you would put it higher, like the property appreciation and this?
No, I would keep to whatever the data says.
All right.
I normally just put lower just to be on the safe side, but yeah.
And then we have the occupancy rate. So just for the example, 92% means 1 month every year the property will be with no tenant inside. What would your assumption for this?
I normally have I normally account for 2 weeks of void, so basically half a month. So I would stick with a 95% or 96%, yeah.
All right, it's 96%. So it will take it into account in the calculation. So basically, we reduce the rental income for for every year, basically. Okay, so with the default scenario, with perhaps the most probable scenario, you can see the metrics. So the net cash flow, so you will have around 1,600, a bit more every month. 20K a year. The cash on cash is 12%, means that what is the net cash flow on top of your cash investment. So if it doesn't take into account the loan, but it takes into account the mortgage interest payments. Okay. Then the gross deal is the rental income on the entire purchase cost. This is almost 8%. The net yield is the net cash flow on the entire purchase cost. It's also not bad, 3.6%. Then the first year ROI, this is due to the work that we
increase in value. Yep.
And the cap rate is 6.8. And then you have the long-term metrics. And here you can see, because of the property appreciation mainly and the cash flow generation year over year, it's very nice ROI for the long term. The IRR, the internal rate of return, means that this takes into account also the property appreciation. So because of that, it's almost 20% every year. And we have like other metrics that don't have time to speak about them. And you can also click on the holding period breakdown to see the development of your equity net cash flow over the years. And then in the what if scenarios, I can also create the best case scenario. So in the best case, perhaps we can, put even like 12%, and then you can see how your
significant change. Yeah, of course.
And then perhaps we can reduce the inflation just because it's a best case scenario. And then the occupancy rate can be even 98%. And then so this is the best case scenario. But you can also do the worst case scenario. So the worst case scenario, let's say property appreciation of 1% only every year, rental appreciation of 1%, inflation on 11%. It's very, very pessimistic. So let's reduce it a bit. We don't want to be like over 10 years every year, and very low occupancy rate. We can also increase it in the worst case scenario. And then you can see it's still, I think, nice return for this specific deal.
Yeah, I mean the IRR is almost like 13, 12.5%, even on a worst case scenario. And to be fair, like, you know, like we said before, with this analyzer, we haven't factored into account the whole BRR element, right? Which is that your cash investment is not going to be as high as we're saying it is, because once the value goes up, you're going to refinance the majority of your funds in this case. So this, all of these will significantly increase, you know, if you were to do it that way. But it just shows you, as even as a plain buy to let, that it could do very well.
Yep. Yeah, I agree. Then you can go to the prospect report, you can upload pictures and then export it to a PDF. Okay, so I think that's it for this specific deal. You can click on the finance this deal also to see your mortgage options, or if you want to take bridging finance. So here Lendlord is the lender, the actual lender, and you can start the process with us. Okay, so Ahmed, if you have a few more minutes, we have questions on the chat, and I still need to review them, and perhaps we can answer. Ahmed, can you still hear me? I'm not sure if it's me or can you still hear me? If you can put like a note in the chat, or just unmute yourself. I'm not sure if it's Ahmed or myself. You can hear me. Okay. All right. Okay. So I will wait for Ahmed to join, to reconnect. Let me see if I can answer some of the questions. And in the meantime, I put the links on the chat. So if you haven't created your Lendlord account yet, you have a link to sign up for free. And then, of course, if you want more features, you can upgrade to the premium plan. You can schedule a demo. There is a link for that. And also, if you want to apply for bridging finance, there is a link for that. And of course, subscribe to our YouTube channel. Then let's see if we have some questions that I can answer. During refurb period, how do you cover mortgage costs? So I think, so basically, when you take bridging finance, there are two options. So, okay, Ahmed joined us. 1 second. So the one option in bridging is to basically add the interest to the loan. So you don't need to make monthly payments to the lender, but the interest will be capitalized and you will need to pay the entire loan amount with the accrued interest in the end of the period, after you improved the value of the property or after you get a refinance with a higher value. So you don't need to make monthly payments. We provide an option to get a higher loan to value, 75% loan to value, but just if you can service the loan month by month. So if you have this option, you can get more money in advance. So usually this is the way it works when bridging. Ahmed, are you with us again?
Yeah, you just threw me off.
What happened? Like it was the signal, I think, no? Or
yeah, it's a signal. It just cut me off.
Okay. So good that you are here with us again. I answered the question how you cover mortgage costs during the refurb project. So it's that, you know, usually you will capitalize the interest, and you can also get a second advance or refurbishment development finance to cover the refurb. You see, you already answered this, Ahmed. I see.
I answered that one, yeah.
Right. Okay, let's see. Rob asked, I have a purchase budget of 200K to 240K for my first flip. Looking at East London or South East London, would a purchase for a 1-bed to 2-bed conversion be possible in current market prices? What profit could be feasible? I don't know if you can answer that, Ahmed, but.
You know, I think depending on if you were on the call right at the start of the call, we mentioned that even if you're looking to flip and, the worries about the current market climate, right? I would do what we just did today, which is go through the flip analyzer and go through the hold analyzer. And as long as both of them work, then you're okay, right? Because you might go into a flip deal thinking, well, okay, maybe I can make a 15% margin. Let's just say you can't because the market is not where it's supposed to be. Then at least you can still refinance and hold out and wait 6 months, wait 12 months, and you're not going to lose money, right? Like once the market recovers, you can then flip at that stage and sell. So it's very hard to say what sort of margin because each deal is different. But I think if you do both the analyzes, it's very hard to go wrong, as long as it ticks both of those boxes.
Yep, I agree. Okay, why use bridging loan when we could use tracker or variable rate mortgage? Any reason other than quick turnaround on loan? So I would try to answer first, Ahmed. I think that the thing is the better choice, of course, is a mortgage. So if you can get a mortgage, get a mortgage. The problem is that with buy to let, the rental income, it's one of the main factors for lender to provide you with a loan. So if the property is not habitable, if you can't get a tenant on day one, it's very hard to get a mortgage. So this is one reason. So perhaps you need to do some improvement to the property before you get a mortgage. The second thing is speed, because if it's an auction purchase, you need to complete the purchase usually between 4 to 6 weeks, but there are auctions that perhaps 2 weeks or 8 weeks. So there's not enough time to get a mortgage. And if you want just to compete, perhaps, if you like, it's like a cash purchase, and then you can get bridge finance and then refinance it quite immediately. With Lendlord, by the way, Lendlord bridging, we have a dynamic product. So if you take the loan just for 3 months, so the term is 12 months. So you can repay the loan after 12 months. But if you make early repayments after 3 months, the rate will be very low, and then 6 months will be a bit higher, 9 months. So we basically, if the property is almost ready for a mortgage, you can take the bridge finance and then remortgage it. But usually on bridging, the reason is because you need to do some refurbishment, some improvement to the property. Ahmed, if you want to add something.
Yeah, all of those are fair. Two more things to consider is, the deal we went through today is a house that you're turning into 4 flats. You can't do that under a buy-to-let mortgage anyway, because if you have a buy-to-let mortgage on that, the mortgage is on the house. You can't then just chop it up into flats because, well, then the mortgage would not be valid, right? So therefore, that's one reason. The second reason is, even if you could, it generally can, doing development works under a buy-to-let mortgage is sometimes considered mortgage fraud, because a buy-to-let mortgage is, as it says, buy to let, not buy to develop, refinance, and then let. So it depends where you draw the line with that. But yeah, generally speaking, if you're gonna do works to it, bridging finance is the way to go. By the way, bridging finance, it's actually, it doesn't have to be as expensive as people think, because, for example, with most projects, of course, the deal we went through today is a bit more complex, but if you were buying a 1-bed and you were turning into a 2-bedroom, let's just say you get a bridging finance loan. The bridging finance is £1,400 a month or £1,800 a month, right? Now, you might think that's expensive, but if you can do the project within 2 months and get that done very, very quickly, and then rent the property out, and the rental is £1,600 and your bridging cost is £1,400, technically from month 3, it's not costing you any bridging finance because you're recouping it from your cash flow anyway. So, when you account for all of that, it's actually not as bad. Whereas if you get a, let's say a mortgage, and the mortgage fees are £5,000, £6,000, if you were to then refinance, you've still had to pay those £6,000, because that was added to the loan. And so you're still out of pocket when you refinance. So if you actually do the maths, bridging finance is not that bad if you do it quickly. And if you need more time, so for example, you were turning a house into multiple flats, well, you can't do it under a buy-to-let mortgage anyway, so there's no questions there, right? So I would say do the numbers. It's not as bad as people think.
Yep, I agree. Damian asked if we can send the recording of this webinar. So just subscribe to our YouTube channel. There is the link on the top of the chat, and we will also send an email, of course. Let's see, are these hard searches or soft searches? Not sure related to what, but if it's
Oh, when you were looking at when you were going through the finance options and you click finance this deal.
no, there are no searches, nothing. No. Like we basically, it's automatically. So basically, it's the algorithm just analyze your portfolio that you manage on Lendlord, and based on the criteria of each lender, it will match the best optimized product. So it's totally digital, but nothing personal. It's not doing any search. Just based on the data that you entered to the deal, and then the data that you entered on my portfolio. Is there a way to see sold prices for property local to where you are buying to get an idea of end value, or even rental prices to get an idea? So we use in the postcode information, you can see indications about price per square foot, and also the property valuation. But we will look to add also the data that is available for properties that in this area in terms of sold prices. Would the available mortgage be based on ICR subject to stress test? I will try to answer, and then Ahmed, let me know if you have any thoughts about. But basically, the ICR, it's the interest cover ratio. For the portfolio level, lenders will do it only for portfolio landlords. So if you have 3 or more buy-to-lets properties under your name, even with not full ownership. But if you have less than 3, then the stress test, the ICR, will be on the property level and just on the property level. So if you have 3 and more, then it will be on your entire portfolio. And if you have only only less than that, then they will stress it on the property level. And what it means is basically, if the rental income is too low, so let's say that that will go to finance, this window, finance mortgage search. Okay, so if I reduce now the rental income, I don't know, 500, okay, I click search, then you see that the platform basically it failed the ICR, okay, because the rental income is too low. So basically, with this rental income, you will not be able to get a mortgage. But if you increase it, then you will be able to get a mortgage. And also the stress test can be on the entire portfolio level if you have 3 and more. So the lender will take a look on the entire loan amount and rental income and mortgage payments. So for your entire portfolio. So this is basically the ICR and the stress test. Another question for you, Ahmed. When purchasing this property, what are you going to spend on the 150K?
Oh, well, that would be the extension, right? There was a garden on the side, so in order to get 4 flats out of it, it would need a pretty big extension. So yeah, it was double story on the side and potentially a single story on the back. So yeah, mainly the extension, and then obviously the internal, reconfiguration as well.
Okay, can you run though again how you are showing the BRR metrics? So currently the BRR metrics are not available on Lendlord. The best way to do it is to start with Flip and then do the rental analysis. I know I keep saying it's still in the roadmap, and hopefully we'll release it soon. It's definitely in our plan. Avian, with your bridging offers, you typically loan 75% certificate. You mentioned recently that it might be possible to provide the remaining 25% by placing a charge on an existing unencumbered property. Can you elaborate at all on how this works? Would like to consider this method to cover all the purchase if possible. So yes, definitely. So if you can provide a second security and you have enough equity, so if it's unencumbered, or you have, even if you have a small loan or you increase the value, or the value just went up, then we can definitely release more funds on day one, but we will take 2 securities. we can also take three securities. So we take the property that you're about to purchase as a first charge, and then we'll take a second security. It can be also a first charge if it's unencumbered, or a second charge, but second charge is more challenging. We need to see that there is enough equity in the second security, second property, but definitely it's feasible. And then this is a great way to get more than 75%, because basically you can allocate your equity of your other assets for this purchase, increase the value of the property that you purchase, and then repay the entire loan. Are we able to refinance using a 5-year fixed rate mortgage and just increasing the loan rather than obtaining a new remortgage, which would incorporate early repayment costs? I mean, you want to answer this? It's a calling. 9.
I can answer that. Yeah, no, I've got it. Are we able to refinance using 5-year and just increasing it rather than obtaining a new mortgage? Are you able to refinance using it? I'm not sure what that means. I'm a bit confused. I don't know. You normally, I normally, what I tend to do is I'll buy on bridging finance and then I will refinance onto a 5-year fixed mortgage. And so if you're doing BRR, then you're going to have to remortgage. I don't think you can just switch products because of course you want the new valuation in order to get, the uplift in value. So I'm slightly confused, but I think that's what the question was, that do you need to remortgage or not? And the answer is you do need to remortgage.
You need yeah, definitely. It's a new product, probably a new lender.
Yeah, for sure.
All right. Avram and Ahmed, in the current economic climate with high interest rates, especially using limited liability settings, deal analysis is becoming increasingly tricky. What do you think? So I would say because of that, you need to run all the scenarios. So you need to run the worst case scenario, the best case scenario. You need to play with the loan section and say, okay, if the loan rate is 7% or 8%, okay, it might be in, I don't know, 2 years, hopefully not. What would what it mean to my net cash flow or to the long-term metrics? So definitely because of that, I would say even like the opposite. You need, in this climate, you definitely need to analyze the deal before you make the purchase and take into account all the different scenarios. So yeah.
I would say, yeah, I think it goes back to, what you consider a good deal, right? Because for example, if you're doing buy to let, a good deal for you is something which can make a 14%, return on investment over the period of 5 years, then it doesn't really matter what's happening in the next 6 months, 9 months, 18 months, because if you put in the rental analyzer and you make the assumption to 5 to 10 years, then assuming the UK economy picks up, but it's like the odds are that it is going to pick up, then I think it goes back to what I said right at the start of the call. Like, you have to define what a good deal is. And if a good deal is, it has to make a 20% return tomorrow morning, then a lot of deals are not going to work because, in this current climate, that's very, very hard to do. But if your goal is to make a 20% return over the 10 years, then it's, far easier and a lot of things will work.
Yeah, I agree. Most you have a property on your name or business name before you could be approved for bridging finance? No. So basically, even if you just exchange, like you have accepted offer, you in the process, eventually, of course, you will get the loan just after your name. You own the property, but you can start the process for like a new property that you don't own yet, if it makes sense. Okay, Ahmed, you got a new follower in Instagram.
Nice.
Can I take a bridging finance to flip 1-bed flat to 2-bed flat if I have no capital at all? So my recommendation, if you don't have capital at all, wait to have some capital. This is my opinion, because property, you need to take into account many things that might happen, and you need to have capital to start. You can use the strategy of that we discussed before, like to provide other securities, but then it means that you already own a portfolio with equity inside. But if it's your first property, definitely you need capital to get started in property. I'm not sure like huge capital or like, but you need something. And I would definitely put like 25, 30%, so 35% of the purchase part of the property you intend to buy. What do you think, Ahmed, on that?
Yeah, no, exactly the same, that I think you do need some capital. Now, to caveat that, it doesn't have to be your capital. You could work with investors. What I recommend to people if you have no capital at all is just do kind of similar to what I did right at the start when I was doing rent to rent, which is just work for someone for free or on commission basis. Just literally learn as much as possible, build credibility, and build. When I say a portfolio, I don't mean a property portfolio, but like a presentation of, hey, I've done this deal, I've done this deal, I've done this deal. You have done it, but with other people, like almost like an architecture portfolio, right? Like, this is what I've been involved in, this is what I've done. Because once you have that credibility and that experience, you can then raise that 25% quite easily. So, when I invest in when I buy a property and I have to put down a 25% deposit, I don't put the full 25 myself. The majority of it, I'll try to raise from investors, and I'll put down a portion myself as well. So you need capital, like, of some sort, but of course it doesn't have to be out of your own pocket. So, and if you want to fill that gap, just work for someone for free and get that experience.
Okay, good question, good answer. I think that we are running out of time, so we'll pick, I think, one or two last questions, but feel free to reach out either to Ahmed or to Lendlord's team or to myself. You can schedule a demo, or you can
put my email here as well if someone wants to get in touch.
Perfect. Let me see if like last question that might be interesting for everyone.
Akeem had a question about comparables, which I think is useful for everyone. Normally I'll look at a quarter-mile radius in the last 6 months in an ideal world. Sometimes it's tricky, but in an ideal world, last 6 months, quarter-mile radius, and similar size properties, similar type of property. You want to, whatever you're looking at, you want to look at the closest thing possible, sold in the nearest amount of time possible, because that's as close as you can get. The big problem with property is that it is a bit subjective, because we can all have our own opinion. It's very hard to verify who's right and who's wrong, and so therefore the closest thing, the closest looking property, the closest size, the closest sale date, that's in an ideal world what you want. If it gets, when that becomes hard, I stick with quarter-mile radius, and then I go 12 months, and then if I can't find anything, then I go half-mile radius. So you start small, try to see what you can find there. If you can't find anything, then you increase your radius slowly, but you don't just look at it like a 5-mile radius from the start. You want to hone in and then expand.
Yeah, and I will take perhaps the last question about the platform, the important question. A quick question regarding the Lendlord platform itself. Are the details of the portfolio we enter shared within anyone else apart from the financial lenders? So we don't share your details with anyone, also with not with the financial lenders, unless you apply for a mortgage, and then if you need to get us your approval to submit the application, and then the lender will request the information. We take security seriously. You can use the settings on Lendlord to apply for two-factor authentication. We don't share your data with anyone. No one can access the data. The passport are hashed, the communication is encrypted, and we use security groups on AWS to secure our servers. The only way that, let's say that there is a problem, like an issue that needs to be investigated by the support team, they will need to ask your written permission to access the logs and the data. But it's the only case that someone can review some of your data, but without your written permission, it's not possible. So I think this is something that I wanted just to emphasize. Okay, so I think we can call it for today. So just a reminder to the links above, and also you have the email of Ahmed. You put it there, Ahmed, on the chat?
Yeah, I think I did.
Alright.
Yeah, I did. Yeah.
Okay. So if you haven't created your Lendlord account, just do it. You can schedule a demo, apply for bridging finance, and subscribe to our YouTube channel. So thank you. Thanks everyone for joining. Thanks, Ahmed. It was great.
Thanks for having me.
Very helpful, very informative. And thanks everyone. Have a great night, great evening. Thank you very much.
Brilliant. See you soon. Thanks. Bye.